Hi everyone and welcome to a brand new episode. I'm Marcus and today we're looking at Qualcomm, ticker symbol QCOM. We'll cover the business, the income statement, balance sheet, cash flow, key figures, our key feature, and the technical aspect of the stock. Should we be buying the stock? Let's find out. Qualcomm is the world's leading wireless technology innovator and the driving force behind the development, launch, and expansion of 5G. Qualcomm's technology are found in every 3G, 4G, and 5G smartphone. They're bringing the benefits of mobile to new industries, including the automotive, the Internet of Things, and computing. The CEO stated recently that there is a great opportunity ahead as mobile technology is going everywhere and virtually in every industry. Qualcomm aims to be the company that sets the pace of innovation in mobile. We have seen an increase of digital transformation and everything is being connected to the cloud, as well as everything becoming more and more intelligent. You have, for instance, high performance computing in every device, and the company sees an incredible opportunity in what they call the connected intelligent edge. This is where billions of smart devices built on mobile technology will be connected to the cloud 100% of time and fuel the cloud economy. The CEO believes that the addressable market will expand by more than 7 times to approximately 700 billion in the next decade, and that their technology positions them to be the partner of choice for both mobile and the connected intelligent edge. The cloud is growing about 35% year over year, and 64% of data will be created outside the data centers, and the aim is that the billions of devices connected to the cloud to be driven by Qualcomm technology. And that is a bold statement and an exciting news. And the product that is going to make this possible is one, mobile. When it comes to the mobile, the company are focused on premium high-tier Android smartphones, and they have been setting the bar for performance in the industry. The latest Snapdragon 8 Generation 1 have become synonymous of what a flagship smartphone is. The second offering is our RF front end, and Qualcomm have developed modems all the way to antenna, and they have exceeded the targets and are now the #1 wireless RF front end provider. And the third thing being Internet of Things, which is one of the largest opportunities within their addressable market, and they are active across 3 categories: consumer, edge networking, and industrial, and they have about 13,000 customers right now using the solutions. And lastly is the automotive industry, which is undergoing one of the fastest transformations in present time. The car is becoming a connected computer on wheels, and Qualcomm are working with 26 global brands right now. And with that said, let's look at the numbers. Qualcomm is traded on NASDAQ and are in the manufacturing sector. If we go down to the screen, we can see that their market capitalization coming in $178 billion and the revenue coming in at 36. PE ratio is at 18. I like it because I like companies with a PE ratio of 20 or below. So coming in at 18, that is a plus. I like it. But guys, when you see a stock with a high PE ratio, that tells you that the market expectation of that stock is high, and therefore there are a good chance that you might see capital gains on those stocks, because there's a lot of investors that is pushing the price even higher because they're expecting better and better numbers. But the overhanging risk is if the company cannot meet those expectations, we will see the stock price fall. Same thing goes when you see a stock with a low PE ratio. That is telling you that the market expectation of that stock is low, and therefore you might not see capital gains on those stock. Just keep that in mind. So profit margin coming in at 27%. I like it because I like companies with a profit margin of 15% or higher. So 27%, that is just amazing. So that is a plus. Price to sales ratio coming in at 4.9. Normally, I like companies with a price to sales ratio of maximum 4. So I understand 4.9 is not far from the threshold, but still higher than what I normally like to take a look at. So that is a no for me. Price to book value coming in at 15. I like companies with a price to book value of maximum 3. So coming in at 15, that is just way too high for me. So that is a no. So if we were to summarize, PE ratio within the range, price to sales ratio is too high, and the price to book value is too high. This tells me that Qualcomm at its current state is overvalued. So they pay out a dividend of $2.69. I like it because I like those recurrent income. So that is a plus. Effective return at 1.7%, that is just way too low for me. I would like to see at least a range of 2.53%. Acceptable number would be around 6%. But guys, I want you to be very careful here, because it could be a trap. Every time you see a stock with a high effective return, that could be a trap, because what the risk is that you might get a good return as long as you hold those stock, but when it comes time for you to exit the stock, you might not get a higher price than what you bought it for. So make sure to look at the chart, the history of the company, and see, is this stock consolidating, or is it moving in a negative trend channel or a positive trend channel? And how about my exit strategy? Will I be able to get a higher price than what I bought it for? So keep that in mind. So coming in at 1.7%, that is too low for me. Return on equity 106%, I like it, so that is a plus. Now guys, return on equity tells you about a company's ability to create return on their equity, meaning ability to create a return on the capital you're about to invest in them. So coming in 106%, I like it, so that is a go. Return on assets coming in 17%, I like it, so that is a go. So the stock is currently traded at $150 per share. If you go down to the moving average, we can see that we are below the 50-day moving average, but also below the 200-day moving average. This is a signal indicating that we might see the stock price decline. But if we take a quick glance at the chart, we can see that we have been consolidating for quite some time before the price broke out of this channel, and have been since consolidating more or less, but has of lately seen a negative trend channel. But we'll take a closer look at the technical aspect of the stock further down. But let's jump over to the income statement, and what we can see here is that the total revenue went from $22.3 billion in 2017 up to $33.6 in 2021, and these numbers have been improving every year. We fell off a bit in 2019, but have since improved, so this is a plus. Gross profit went from $12.5 billion up to $19.3 billion, and these numbers have been improving every year. We fell off a bit in 2020, but overall trend is positive. Net income went from $2.4 billion up to $9 billion. We fell off in 2018, but have since seen better and better numbers. This is a plus. I like it. Now let's jump over to the balance sheet. What we can see here is that the current assets versus the current liabilities, and we can see that there's a huge difference between the current assets and the current liabilities. Basically, it's telling you that if the company were to convert their current assets to cash, they're able to pay off the current liabilities and still have capital left on the table. So that is a plus. But they are far from being able to pay off their total liabilities, which is negative. If we take a look at the total liabilities, we can see here is that it went from $34.8 billion down to $31.3 billion, and we can see here that they have reduced the start reducing these numbers, but has of lately seen higher levels. I like the fact that they are paying off their total liabilities, which is amazing. That is a plus. I like that. But at the same time, we're now seeing that the total liability is growing again. So I would like to see them start reducing the total liabilities and reduce the rate which is growing. But overall, I like what I'm seeing here. So the outstanding shares went from 1.5 billion shares down to 1.1 billion shares, and these numbers have been falling over the last 5 years. That is a plus. So guys, what is happening here, when you see that these numbers are decreasing, that means that the company is doing buybacks, meaning that there are fewer and fewer available shares out there, meaning that your share of the company is growing. If we would see that these numbers increase, that would mean that the company is issuing more and more shares, meaning that there are more and more available shares out there, meaning that your share of the company is decreasing. You're being diluted as investor, and there's a lot of investors that either skip this part or doesn't know about it, because they've been looking at a balance sheet and see a company with a strong balance sheet. For instance, the assets are there and the debt is not growing that much, but on the other hand, we can see that the company is issuing more and more shares, and that is negative. But at the same time, that's a way for a company to bring in more capital without taking on more debt. So seeing that these numbers are decreasing, that is a plus. I like it. Now let's jump over to the cash flow, and what we are interested here is that the operating cash flow versus the capital expenditure, and we can see here it went from the operating cash flow came in at $10.5 billion and the capital expenditure are at $1.9 billion, making this a difference of $8.4 $4 billion, which is a plus. And we can see the operating cash flow went from $5 billion up to 10.5, and we fell off a bit in 2018, but have since seen a better and better numbers. We fell off again in 2020, but overall trend is positive. I like that. Capital expenditure went from 690 million up to 1.9 billion, and we can see that these numbers have been improving every year. That is a plus. I like the fact that they continue to invest in the business, so that is a plus. Now let's jump over to the key figures, and what we can see here is that the earnings per share went from $1.6 per share up to $8 per share, and we fell off in 2018, but have since seen a better number, so that is a plus. Revenue per share went from $15 per share up to $29.8 billion, and we can see that these numbers have been improving. We fell off a bit in 2020, but overall trend is positive. Equity per share went from $20.8 per share down to $8.8 per share, and we can see that we fell off a bit in 2018, but have since seen better and better numbers, so that is a plus. Dividend per share went from $2.2 per share up to $2.6 per share, and we can see that these numbers have been improving. We fell off in 2019, but have seen better and better numbers. And also news just broke out that the company is increasing the dividend by 10%, so they'll be paying out a dividend share of $3 per share. So that is amazing. I like that. I like it because I like those recurrent income, and also the fact that the income is growing, so that is a plus. Dividend payout share, a lot of fluctuation. We see 133%, negative 69, 67, 54, 33. I like it because I like companies that pays out less than 60%, because I want some of the capital to remain in the business for investment, acquisition, and just overall strengthen the business for uncertainties. So I like this. Gross margin went from 56% down up to 57%, and we can see that they fell off in 2018 and have seen better and better numbers, but has of lately seen lower and lower numbers. So this is negative. So basically what is happening here is that the cost of goods sold is increasing, and the company needs to find ways to become more and more efficient. But at the same time, these are huge numbers, but we need to compare this number across the industry and see how is Qualcomm doing compared to the competitors. But looking at these numbers, they need to find ways to become more efficient, so this is negative. Operating margin went from 13.4% up to 30.6%. We fell off in 2018. I have since seen better numbers, so that is and it fell off in 2020, but overall trend is positive. I like that. Profit margin went from 10.9% up to 26.9%. We fell off in 2018, but I have since seen better and better numbers, so that is a plus. Return on equity went from 7.9% up to 90.8%. We fell off in 2018, but have since seen better and better numbers. We fell off a bit in 2020, but overall trend is positive. Return on asset went from 3.7% up to 21.9%, and same here, we fell off in 2018, but have since seen better numbers, so that is a plus. Solidity tells you about a company's financial strength for the long term, and we can see it went from 46.9% down to 24.1%, and we can see that these numbers have been decreasing, but has of lately seen a better and better numbers, so that is a plus. I like that. But at the same time, we can see that Solidity have decreased over the past 5 years, so that is a negative. But I like the fact that for the last 3 years these numbers have been improving. Balance sheet liquidity tells you about a company's financial strength for the short term. We can see it went from 9.3 down to 1.1, and we can see how we've been doing lower and lower numbers, so this is negative. But at the same thing here, we've seen that these numbers are improving, have been improving for the last 3 years, but overall negative, so that is minus. Debt ratio went from 1.1 up to 3.1, and we can see it grew rapidly, but have since seen lower and lower numbers. I like the fact that these numbers are decreasing, but still over the last 5 years it has been growing, so that is negative. So basically, guys, a debt ratio of 3.1 tells you that the company have 3.1 times more debt than equity in the business, so that is negative. But guys, we have gone through the income statement, balance sheet, cash flow, key figures. Now over to our key feature, which is the stock analyzer. And what the stock analyzer does is that it gives you a holistic overview of the company's performance. If you want to dig through the numbers, you can dig through the numbers or have the software do the heavy lifting for you. If we go down to the screen, we can see that the PE ratio is below 20, which is positive, and the dividend, the payout dividend, which is positive, and the dividend payout share is less than 60% positive, and the dividend decreased over the past 5 years. That is negative, but I like the fact that they recently announced that they will increase the dividend, so that is positive. I like that. Number of outstanding shares have decreased, which is positive, and revenue increased over the past 5 years. That is positive, and profit margin above 15%. That is positive, and profit increased over the past 5 years. That is positive. Current assets is greater than current liabilities. Positive. Solidity decreased over the past 5 years. Negative. Balance sheet liquidity decreased over the past 5 years, negative, and the debt equity ratio increased over the past 5 years, negative, and the total liabilities have reduced over the past 5 years, positive. As you can tell, it gives you a simplified, holistic overview of the company's performance. And you can have this software along with everything we've gone through, plus access to our discussion forum where you'll be able to chat with me along with other members for only $10 per month. So make sure to head over to comus.se and become a member today, okay? But let's jump over to the technical aspect of the stock. So here we have the chart. As you guys can see that we have been moving within a positive trend channel for quite some time, but has of lately been more or less consolidating. We can see here that the price broke out of this channel and have reached a ceiling and reached a ceiling up here and are now back within the channel, and we can also see a gap over here. Guys, every time you see a gap, just remember that gap will need to be filled again. So whenever you see something like this, just know that this gap will need to be filled again. So you will eventually see the price go down and fill that gap again. The same thing goes when you see something like that, something like this. Just know that eventually that gap will need to be filled again. So this is what's happening right here. So seeing that this price is coming back down, I believe if we take a closer look here, let me see here, let me do a parallel line, something like that, and we can see is that we are now moving within a negative trend channel here. So if we are now touching the support line, so we could see eventually that the price climb a bit before reaching the ceiling and potentially going back down. So this is a key area to be watching and something to be very cautious about, because what could happen here is that we could see a bounce back, and if there's a lot of buyers coming in and push the price even higher, that would be amazing. So what I would do in that situation is that I would wait for the price to break above this area before doing my entry, because I could see, if you were a day trader, you could see a potential increase of at least 12%. That is okay. That is not a huge move, but it is acceptable move. But I'm not a day trader. I like to hold good stocks for many years and earn dividends plus capital gains. So what I would do is I would wait for the stock to go back down and price to push even higher for a potential buy. Otherwise, I would wait for the price to go back within the channel and hopefully start moving back within this channel for a potential buy down here, because I know there will be a lot of buyers waiting to enter the trade. Plus that will be giving me better returns on my investment. So that's what I would do. So if you are to summarize what I think about the company, I like the fact that it's a large cap company with a strong portfolio of products and an exciting future. And looking at the valuation, the company is currently overvalued, but we could see a decrease in stock price, making the company much more attractive. I would be happy if I could acquire the stock around $120, $130 per share for better returns. And looking at the financial, I like the fact that the revenue is growing as well as the net income, and also the fact that they have been reducing their total liabilities. There are a lot of things I like about Qualcomm, but I will also want them to improve their gross and operating margin as well as balance sheet liquidity. So if I would score the company, I would give them a score of 77%. So that's how I would trade the stock. How would you trade the stock? Please let me know in the comment section below. And as always, let me know if you have any questions or have stocks you want me to look at. And as always, please do your own analysis. And thank you so much for watching. I am truly grateful and appreciate it. And if you have enjoyed this episode, please give me a thumbs up, comment, subscribe. And until next time, guys, take care. Bye-bye.